Thank you all for coming. And this session is called the Beyond the Belt and Road Initiative, right? Because I wanted to talk about the capital, raising capital in Asia, especially raising capital in an environment where there are no capital markets, right? It's mainly a bank-based financial system. So what I'd like to do here is to say, Asia has really been growing so rapidly that there's been enormous growth in investment opportunities. But how do we identify them? And the reason why this is such an important topic is because the entire Milken mandate has been to ensure access to capital markets to promote job growth and good health. And so access to capital is really key to the Milken story and the Milken reason for being here. So what we like to do in this session is to talk about how the Belt Road Initiative has highlighted a lot of the investment opportunities that come with infrastructure and the difficulties that we find in trying to raise capital to finance these enormous infrastructure investments. And in doing so, to highlight that issue of how do you direct investment capital in a world where there are no markets, in a world where it's mainly banks that do the financing, and banks do the financing through using private information. And I think that's the problem that faces a lot of the global economy outside of US and the UK, where there are extensive capital markets. So this program then is to talk about infrastructure, how do you identify the good investment opportunities, and how do you finance them? And this panel is exactly the right expertise to try to address these problems. So what we have here is a setup where Joaquin von Unsberg, right? He's the vice president for policy and strategy at the AIIB, a multinational institution that's set up exactly to handle this problem of identifying infrastructure investments and especially in an environment such as Asia where there's a huge mixture of different opportunities. We also have, on my left here, Lincoln Leong. He's the man with the secret sauce, right? The head of the MTR, CEO, who operates not only the very profitable Hong Kong MTR subway system, but a system of railway operations that span the globe from Scandinavia all the way down to Australia, right? And this man makes money, right, when others cannot. So we're gonna ask him, what is it that he does to make this stuff work? And then we come to financing. How do we finance the operation of this large infrastructure stuff? And on my right here is Jerry Keefe. He's the head of corporate banking for Asia Pacific at Citigroup. He's the man who's going to tell us how global banks can create the right kind of investment products to be able to allow Asia to tap into global capital markets. Because we're living in a world where infrastructure investment opportunities, at least in this region, come to maybe trillions of dollars. I've seen some estimates that go to 10, 11 trillion dollars. We have countries and banks that offer up maybe hundreds of billions of dollars. So clearly that's not enough to meet those investment needs. But if you look at the global capital markets, there are hundreds of trillions of dollars of money sloshing around with investors looking for investment opportunities. He's the man who's responsible for creating a lot of these investment products that will entice and signal to the global investor there are some good opportunities here. And so he's going to tell us how he does that. And finally, on my far right is Paul Grunwald, who is the managing director and chief economist Asia Pacific for S&P Global. S&P, as you all know, is a rating agency, but Paul wears many hats, as actually many of our panelists do. But Paul and I used to wear the same hat. We both used to work at the IMF together, and we're representatives for the IMF in Hong Kong. And Paul is going to tell us how to navigate this world where there are no capital markets, because he's going to tell us why there are no capital markets in Asia. He's going to tell us, will the products that Jerry and his colleagues create be adequate and up to the job for financing these investment projects? And he's going to tell us how regulators and rating agencies will look at these products, especially in light of all the financial failures and product failures that we've seen associated with the Asia financial crisis and the global financial crisis of 2008. So that's the program, where we'll talk first about infrastructure requirements, how to identify the good investment projects, how to make them profitable, right? How do we finance them? And what are the difficulties associated with the methods of finance? So we can start the ball rolling Joaquin, AIIB, very new institution that competes with the World Bank, but does similar job of trying to help identify these investment opportunities. And we know that there have been a lot of infrastructure investments, right? I mean, the Asian landscape is littered with underutilized airports, ghost cities, right? And highways that go nowhere. So from a national perspective, a lot of these infrastructure developments have really been quite disastrous. But you've got the job of saying, how do we network this stuff together? And I think one nice thing about the Belt Road Initiative is that it has identified a path of potential investment projects that stretch from ASEAN, west to Central Asia, North Africa, and links ultimately to Western Europe. So has that helped identify good investment projects, or has it made it more difficult? Because, as we all know, coordinating these infrastructure projects is a nightmare. So with that, tell us about it.
Thanks, and thanks for having the new kid on the block, AIB, on this panel. I mean, we were founded specifically to address the infrastructure finance needs of Asia, so very focused in our mandate. And the story on which we were founded is very related to your introductory comments. It's based on the infrastructure finance paradox. And the infrastructure finance paradox, of course, is that on the one hand, you have this huge demand for infrastructure finance. You have governments who come to our office every day and say, here's a long list of projects that we would like to invest or we would like to seek financing for. You have the big studies from McKinsey about the $90 trillion investments over 15 years worldwide, or the ADB, which says $1.3 trillion a year in emerging Asia that's needed. So there's this huge demand for infrastructure finance. But the paradox is that there's also this huge supply. So we have as many representatives of institutional investors come to our office every day as we have government representatives. And those institutional investors, some of them very much in this conference, are asking, well, how can we invest more in emerging country infrastructure? And yet there's demand, there's supply, and yet there's almost no meeting in the emerging space. And why is that? And that gets exactly to the question you're asking, because the demand is not for the same as the supply is for. What a government calls a project is not what an institutional investor calls a project. What a government calls a project sometimes is, in the extreme, the name of a valley where one could possibly one day build a hydro plant. That's called a project. For the investor, the project is a well-structured, well-prepared, bankable structure where you can make financial commitments in a few weeks' time. Now, there are worlds between that. And the question for us, and that's what I think we were born to address, is how do you build a bridge between the two? And it is project preparation, technical work to just get projects going. It's a lot of policy work that other multilateral organizations have been involved a lot, the whole investment climate, regulatory framework. And it is, of course, financial structuring, which I'm sure we'll turn later in this conversation. But first of all, I think it's coordination, because you have so many actors in this. And everyone wants to do the right thing, but nobody can do it without the others. And that fragmentation holds across, of course, the whole chain, from government to the banks, to the equity investor, to the institutional investors, to regulators, etc. But it even holds within government. I mean, infrastructure is big. Infrastructure is physical. It affects many, many institutions. And especially in countries that are not run very top-down, every infrastructure project involves local governments, provincial government, national government, the sector agency, the finance ministry, the environment ministry, you name it. Almost everyone's involved. And many countries, in particular emerging and developing countries, have a hard time coordinating those actors, which makes it so hard. And I think that's where the multilateral development banks often have been playing the catalytical role of bringing players together, saying we're actually able to give confidence something will happen in the end, so it's worth engaging and bringing all these players together. You ask, how do we pick projects? We set ourselves 3 priorities. The first one is set directly linked to what I just said, the infrastructure finance paradox. We want to invest if and when our investments can bring private capital into the space. Yes, we are happy to deploy our own balance sheet, but what really makes us happy is if we can mobilize and leverage others. Because that's when we meet our mandate of actually leveraging our public capital. So that's the first foremost priority. The second two are cross-country connectivity. That's the Belt and Road. How do you coordinate and invest across countries? Not just transport, but also energy, water. And in a sense, it's the same coordination problem you have at the national level, just to the power of 4 or 5, because you have multiple countries that you need to coordinate. And I think while Belt and Road has been great to provide sort of an organizing framework, it is more like an organizing slogan. It is a very high level, very broad, very general, very fuzzy. So I think it's been very useful to focus the minds on the benefits from connectivity, but the hard work of turning corridors or ideas into projects remains, and that's what I described first, all these little pieces you have to put together.
Let me interrupt there for a sec and sort of watch out for jargon, because in Bloomberg they used to say jargon alert, right? And one of the things that Joaquin just mentioned was we choose projects based upon whether or not we can attract global investors and money onto the table, right? So that, to put jargon on the table, is the net present value of these projects. Now, these projects take maybe decades before they really come into fruition, and often are built in areas that are not economically developed, right? So the purpose of putting in some of this infrastructure stuff is because the social benefits dominate the actual economic costs. And those sorts of situations, they by definition don't have a positive net present value. An investor on the outside would say, I'm not going to come to this because it doesn't make money. What do you do with projects like that where it's supposed to do social good, but at the same time, no one wants to invest in it?
Look, a precondition is that a project has an economic rate of return, meaning that it's socially desirable. That's a precondition. Now then you look at the financial side. For us as a multilateral with a development mandate, the sweet spot is those projects that are not on their own viable, that are not purely commercial, that are not the automatic goes where everyone is jumping and throwing their money at. But it's also not the project that will never fly, that you can't scale up because they're ultimately not financially sustainable. The sweet spot for us are the projects where with some credit enhancement, by providing the long tenor, by sometimes taking certain risks that we as a multilateral are better placed than others to take, in particular policy-related risks. Because the governments, who are often the source of the risk, happen to be our shareholders, so therefore they happen to typically behave a little better when we are investor or lender to a project. So it's really about this little value added that then makes the remainder of the package viable for private capital. That's the sweet spot.
Now, Belt and Road, it makes it a little bit more difficult because if individually in this country, it just was on the edge of being profitable or not profitable and attractive for investors, now you link it to another country, it may not be profitable because there's nothing going on there, right? So what do you do when you have these conflicts in the needs of this country compared to the needs of the downstream or upstream countries?
Well, this is
I'm thinking of a railroad or a highway.
Where macro and micro have to meet, right? Macro is you take a map of Eurasia and you draw some big lines and corridors and you call it Belt and Road, and that provides motivation. Right. But then you have to do the micro, which is actually design projects that meet the needs, right, and for which there is an investor or a developer who would actually put their money into that. And that can be public or private. But that means you have to find a project that also is in the interest of and yields either social return for a government or financial return for a private investor to build that project. And that typically starts with projects that are either viable within their own country or that are viable across two countries, rather than with a project that is only viable once you've connected everything from a city in China all the way to Western Europe. Right. And luckily there are those investments, but there are also very difficult segments in those connections. Yes. Think of some of the huge distances in the Central Asian republics where
there's nobody there.
Those projects are typically not viable from a narrow national perspective. So you need to build the pieces over time, and it takes time.
I'm glad you said that because you just opened the door to the 800-pound gorilla that's sitting in the room that I have to ask the question for, which is, whose interests are we really going after here? If it's partly national interests, is the other interest the network interest, or is it China's interest? Where does China fit into the scheme of assessing benefits versus costs?
Well, I think we have to distinguish between Belt and Road and a multilateral like the AIB that I represent. I cannot speak for Belt and Road, but of course Belt and Road is a Chinese initiative, a proposal, and I think legitimately there is also Chinese self-interest in that initiative. But that happens to resonate with many other countries because they see the opportunities of investments in their countries and of trade. And particularly at a time where there's some unexpected doubts about the benefits of trade, I think an initiative that sort of portrays the benefits of trade and connectivity has found a lot of resonance all the way across the Belt and Road corridors. Now, if you go to AIB, we are a multilateral development bank. We were initiated by China, but we are owned by 80 countries. So our interest is the interest of that collective of 80 countries. And we have to have a project developer or a borrower who has to pursue a project. We can't do projects on our own. We're a bank. So we have a member country that comes to us and says, yes, this country, this piece of highway in Kazakhstan is in our interest, Kazakhstan government. Therefore, we're borrowing for that. Or a private developer who says, here we are developing a toll road that's financially viable, come and help us finance.
And that's exactly the issue I wanted to bring out, which is that the AIB has a governance structure that in some ways prevents any one player from dominating the decision-making process.
So I mentioned China initiated AIB, but China holds a quarter, 25% of the capital. The other 75% are held by other Asian and other non-Asian countries. And in the MDBs, I think it's a beautiful governance model because countries have to negotiate, have to come to consensus at the political level. And then you have a very technical management. That's us. We're actually running a bank. There's a political board that takes high-level decisions, but the day-to-day preparation of projects happens by technical staff, driven by whether projects are viable, whether they're technically, environmentally, socially desirable.
Fantastic. Now let's turn to the secret sauce. Now, once we decide that there are projects that we need to invest in and we should be undertaking, right? The key to whether they're profitable or not is how they're run. And of course, the devil's in the details. Lincoln.
Thanks, William.
How did you do this? How do you make something that is not viable in some countries viable under your management?
Now, the secret sauce starts with a soya base, and then to that you add. No, by way of introduction, the company I work for is MTR. We're a builder and connector of communities, starting off in Hong Kong, but we've expanded our footprint outside of Hong Kong. So today, we carry around 12 million passengers every day in our rail transportation. Just over half of those outside of Hong Kong, and just under half of those in Hong Kong. That's every day. Our business model really speaks volume to the success of MTR as a company. Our business model is a value capture model. We call it rail and property. The value capture is capturing the property development and the property opportunities above and adjacent to stations as well as depots. That model has served MTR and our shareholders as well as the traveling public extremely well in Hong Kong over the last 40 years or so of our existence. To give you an example, today we are a company listed on Hong Kong Stock Exchange. Our market capitalization is around 30-odd billion US dollars. If you look at the return which a shareholder, a minority shareholder, would have received from the date of the IPO back in the year 2000 to today, that compound return would have been just under 14% per annum. If you look at it from Hong Kong government's perspective, Hong Kong government is our major shareholder. They own about 76% of our company. Hong Kong government initially capitalized the company. Then the company went ahead with this rail and property model, developed out the rail network in Hong Kong. Today, that network is 231 kilometers. In that period of time, over the last 40 years, Hong Kong government, as an investor, has made something like a 7.8% compound annual return on their initial investment into our company. At the same time, Hong Kong has benefited from having a metro rail network, together with light rail network, of 231 kilometers that delivers on-time performance of 99.9%. We would be, there are other companies in the world, other metro companies that will be delivering similar types of performance, but together we would be setting benchmarks in the world in terms of on-time performance. Whilst at the same time, if one looks at the fares, the average fares which a commuter pays in Hong Kong, that average fare today is around $1 US. So on the basis of And based on this, the secret sauce, the rail and property development model, the business model, what Hong Kong government has achieved is a rail network which is world-class, performance that's world-class, fares which are very reasonable on a global basis, whilst at the same time making a pretty decent financial return as government and as the promoter of this project.
Let me play a little bit of a devil's advocate here, because having lived in Hong Kong for 4 years, I love the MTR. But in some ways, I also didn't have any choice because I didn't own a car. The population density is enormously high. And your ridership is very loyal because there aren't any alternatives. And so when I look at your returns, and I flipped through your 2015 report, it showed that the profits in Hong Kong were enormous. A lion's share of your profits, though, came from the real estate development that was on top of all those tracks and all the stores and things that you collect rent from. Now, in other countries where you do operate, Scandinavia, Australia, London, the profits are really thin because you didn't have the advantage of all that property income to supplement the operations. So in this type of Belt Road initiative that we're talking about, where the possibility of having well-established shopping malls on top of each station is probably not going to be the norm, how do you do that? What do you do there? And yet, I must say, to Lincoln's credit, right, even though the profits are thin in these other places, they're profits, unlike my home in New York, where they're raising the fares like crazy, and they're still running at a loss. So explain a little bit more about the operation, because you guys even run academies to teach how you do this.
We do.
So tell everybody what the secret is.
No, it's a good question, William. Just getting back to the Hong Kong public transport landscape, we are very lucky in Hong Kong in that 90% of our commuters would take public transport. The rail portion, i.e. the MTR portion, is about 48% of that 90%. So there is significant competition, and that competition is intermodal. It's coming from buses and minibuses, taxis, etc. But getting back to your question with regards to how the application of that model, both in and outside of Hong Kong, as well as the operational aspects, you're absolutely correct. If one looks at our businesses outside of Hong Kong, and today we run trains in Sweden, in the UK, in Australia, as well as the mainland of China. Apart from Shenzhen and the mainland of China, the other jurisdictions have not leveraged off or made use of this rail and property development model. Right. Having said that, many of these jurisdictions, for instance, Australia, for instance, the UK, for instance, places like Beijing, Hangzhou, Shenzhen, they're looking to see how they can implement this same value capture concept in their jurisdictions. So when they're planning new rail systems, and there are many rail systems being planned, not just in mainland China or India or the developing world.
You're competing for something in Indonesia right now, aren't you?
No, we are actually been leveraging of our MTR Academy to see how we could work with the metro in Jakarta in terms of training, etc. But if one looks at that value capture opportunity, in many ways it's horses for courses. Value capture need not mean building an 80-story skyscraper above a depot or above a station. The density and the density of usage really very much depends on the city and town planning. At one extreme of value capture, it could be putting in shops in a station. And we've done that in the network we operate in Melbourne. Flinders Street, for those that know Melbourne, is one of their key stations. A few years ago, we put in a bar, coffee shop, and that in itself is, to a small extent, value capture. But what that does is it enlivens the whole station precinct. It adds a lot more activity to the stations. At the other extreme, it would be what we're doing or what we've done in Kowloon Station in Hong Kong, where there are something like 6,000 apartments, 2 hotels, 2 million square feet of offices, another 1 million square feet of shopping centers, all built above a rail station in Hong Kong. So there are really different aspects of value capture. And the aspect that's most applicable for a particular jurisdiction would be really dependent on the economics of that particular jurisdiction.
Right. Well, once we have the investment project, once we know how to run it, we got to pay for it. Jerry.
Hi, Bill.
You know, global investors, they're all over the place, right? They've got different investment objectives, they've got different time horizons, they've got different risk preferences, and they're coming to assess these projects here, and so they're being shown some numbers that show positive net present value. But how do I get hedge fund investors, retail investors, corporate investors, pension funds, insurance companies, endowments, sovereign wealth funds to come into this stuff? Because I want a diversity of players. I don't just want one investor, because if for some reason the tastes change or the objectives change, they all pull out and I'm dead in the water.
Yep.
So what would Citi, or what would you do to help out the local banks with financing, and what kind of instruments would you come up with to entice global investors to come on the scene?
Sure. Look, I think you put your finger right on it. I think if Asia historically has suffered from anything in the financial markets, it's that it's been almost entirely bank dominated. And so we've not developed as a market a deep and extensive base of institutional investors to put, whatever type of product it might be into it. The good news is that's changing. I actually had an email this morning, coincidentally, about a project in Sri Lanka where apparently at this stage we're going to be willing to underwrite the entire thing on the strength of commitments coming from 3 large global institutional investor accounts who are household names in the United States and globally. And this is a very good indicator of the type of progress that is being made. But the key to all of this right now, frankly, is the participation of multilateral development banks like AIIB, entities like Sinosure, entities like JBIC, Nexi, who've supported Japanese infrastructure builds globally. All of that is really what gives investors the comfort to step into geographies that they might not have a deep history investing in, that they might think entail very different risks than they're used to taking on. In particular, there are government risks, and I'm sure Paul is going to go into this, so I won't go too deeply, but there are government risks that typically extend well beyond the typical time horizon of a loan that goes to finance a project. And so, if you think about project finance as being somewhere between a 7 and 20-year exercise, in a given country, you could turn over a government 3 or 4 or 5 times in that time horizon, and that entails all sorts of risks around tariff rate changes or asset seizures in the extreme case that investors just aren't used to taking on. And so, candidly, in the near term, only by the participation of AIIB and wrap providers like Sinosure and others will institutional investors feel comfortable participating in these opportunities in size. Now, from there, where does that go, right? Because you can't forever rely on a relatively small number of insurance providers or other providers of capital like AIB, because that capital is finite and this market has to evolve and it has to develop past
We're
that
talking billions when we need trillions.
Yeah, we're talking billions when we need trillions. The good news is, it's very easy in Asian infrastructure to just get lost in the numbers and say, we need 750 billion a year in ASEAN alone. Well, guess what? It's not unlike what President Obama said when people started talking about infrastructure, and he said, I've looked and there are not a lot of shovel-ready projects that we could go finance. And if that's true in the United States, you can imagine how true that is in Asia. And so those numbers are enormous, but they don't happen all at once. And the projects, the only way that Yakima is going to underwrite a project is if it is shovel ready and has been underwritten carefully and structured carefully, and the investors have cash flows to look at that show that the debt is going to be able to service, to amortize out, and so on. Now, to get to your specific question around structures, what's helpful, right? What takes some of these risks off the table? One is refinancing or longer tail risk, right? The basics of the market in Asia are not going to change overnight. So you're going to have a situation where we will be by and large dependent on banks, whether it's international banks like Citi or local banks in country taking the bulk of this paper. And unfortunately, due to the changes in the Basel rules, long-dated exposures, even at the investment grade level, have become very unattractive for banks to hold. So we've got a regulatory wind sort of blowing the other way. But at the same time, banks would be happy to make loans that are 3 years, 5 years, and in some cases even 7 years out if there was a takeout that was ready and assured.
Right.
And so someone like AIB performing almost a maturity transformation role where you can take a 20-year exposure and for a bank convert it into a 5 or 7-year exposure becomes a very attractive proposition because the risk of that takeout is essentially AAA risk, right? That sort of thing becomes critical. Secondly is structure and creating exposures that institutional investors will find attractive. One thing we've not talked about yet is private equity participation. So obviously, private equity investors are careful in the extreme, and they're great clients of ours, and we hold them in very high regard, in part because of the care and diligence that they exercise when investing in projects. You've never seen someone go through the numbers the way private equity investors do, and so they will want things that look and feel like Lincoln's results from Hong Kong, candidly, regardless of what country it's in.
Right.
And the way you get there for them is by putting structures around it that protect those equity returns and
Now,
provide.
again, I have to watch out for jargon alerts. So,
Yes, sorry.
So Jerry, you need to.
Sorry.
You need to dumb it down for me.
No, I don't, Bill. But
You-
no, I know.
Mike Milken has always said, capital structure is really key to everything.
It
Now,
is.
that's just fancy talk for the mix of debt and equity and different kinds of debt.
That's right.
And so the key is, how do you get the right capital structure? Well, first, it will likely vary by project, right?
Yep.
It's going to be different for an airport or a telecom tower.
Sure.
Right. So deciding how that is done technically is one thing, but what's your objective? Is your objective to get the capital structure to maximize the number of different investors that come in, or is it just to unload a loan off of your books because it's using up very valuable balance sheet capital, and to put it in the hands of, you don't care whether it's a hedge fund or whether it's an endowment, as long as it's off your books. Now that's the claim that's been made of the work of a lot of commercial banks, which is that you are just looking for your exit ramp. So you will develop the capital structure regardless of the appropriateness for the project that's financing.
Sounds like there might be an implicit criticism buried in there somewhere, which I'll try to address. Well, a couple things. I think.
I used to work for Citi, so
No,
I'm not criticizing Citi at all.
I can tell. So I guess to address that from a couple different angles. One, I think the critical part, and Mr. Milken said this in his remarks at the welcome drinks on Wednesday night. And he talked about the risk that a system faces when all you have in the system is banks, yes, and about the need to build out a dedicated and deep following of institutional investors and a broad set of participants. Mm-hmm. And that, frankly, is what MTR enables, it's what AIB enables, it's what the rating agencies, S&P in particular, enables by making things digestible by the market. And so from a bank's perspective, it's about understanding what investors' appetites are, whether it's a tenor appetite, whether it's a risk appetite, and then taking a given deal which has a given set of cash flows coming out of a project, which you can model out and stress, and look at and say, okay, here is the senior most tranche that is relatively low risk. It's 20 years long, but that's a great fit for an insurance company, a pension fund, a university endowment, someone who wants long-dated exposure. Mm-hmm. We actually just underwrote a deal recently in Indonesia. It was the first project bond done in Asia, frankly, in over 10 years. It was $2 billion. It was a 13-year tranche and a 20-year tranche, and the shorter tranche went to a combination of banks and institutional investors. The longer tranche went exclusively to institutional investors, and it was $750 million out of the total capital structure. So wow, There's appetite there.
Oh, absolutely. There's no question in a zero interest rate world, right? Any investment opportunity that promises anything positive is going to be attractive. And if you can give them positive and meets their liquidity needs and tenor needs, wow, that stuff is going to walk on water for everybody, right? But when I hear you talk, I hear echoes of AAA senior tranches of CDOs backing real estate. I hear echoes of Paul.
I know where you're going with this.
Paul, let me take this.
Paul, and I was going to say, Paul, rating agencies that actually rated these instruments AAA, all right? They didn't say it was AAA bond. You just said it was AAA, but it happened to be a structured product AAA. So the poor pension fund in the Midwest that said, I only invest in AAA and bought this stuff found themselves way underwater. Now, I think we've learned our lessons from those days. What is the modern technology doing to avoid those traps? What is it that we can do to make these structures something that will allow that poor pension fund chairman to go to sleep at night?
Here, Paul. I'm happy to take that.
Well, you start and
yeah, I'll start and then you come over the top. Look, I think just to deal with the very simple issue, the issue with the mortgage crisis was the underlying asset, right? And so if we agree that financing infrastructure in Asia is going to only be available for bankable commercial projects that have cash flows that look to be adequate to service the debt, then that should be the answer. Now, a lot of things happen between the time a deal closes and the time a deal matures. A lot of those are risks that I mentioned, and Paul can touch on as well. But those are risks, and they're in the price, as they say. But I just think that's a fundamentally different issue. There's no harm in creating structure that appeals to various investor appetites. So if you have a shorter tranche that is highly rated that appeals to banks, that's appropriate. If you have a longer dated tranche that's highly rated that appeals to pension funds and others, that's appropriate. And if you have a tranche at the bottom that is equity that is highly levered and highly risky, but the type of investment that a private equity sponsor consider themselves capable of underwriting and understanding and digesting and owning that risk and earning an appropriate return for taking that risk, that's appropriate too. And so I think, for us, the challenge is in some ways finding critical mass at this stage. And I think the good news is, as I said, the 12 trillion or 5 trillion or whatever number you want to use, that doesn't all come at once, right? We don't have to close all those deals next week. And so for us, it's an exercise in building the investor following and making sure that the deals that go through the market are appropriately structured and are structured in a sustainable way, because this is a long game that we're playing here. There are infrastructure needs that go out for generations that we need to service. And so no one on our side of the table wants deals that blow up in year 4. Right?
So that's really, in fact, that's sort of the global bank secret sauce, right? That you can take the stuff that a loan officer is able to identify as a good investment opportunity, and the loan officer could be an AIB, or it could be just a mom and pop shop, but whatever it is, you're able to identify the investment opportunity and then transform it in a way that is appropriate to be held in the portfolios of a wide range of investors out there.
Yeah, the other thing that I think is important to investors is that there's skin in the game here too.
Yes.
Right? I think the big criticism of the underwrite to distribute model in the pre-crisis years was that there was no retention of skin in the game. Here you have the bottom part of the capital structure being retained by some combination of multilateral development banks, private equity investors, the country itself, banks, investment banks. So there will be risk retention essentially at every point if you were to slice the capital structure vertically. You'll see that, and investors will insist on that just because that's the nature of these types of financings.
Well, Paul, how will the regulators regard this, and how do you guys in the rating agencies look at this new generation of structured products and financial instruments?
Yeah, well, first, 2 preliminaries. One, on behalf of S&P Global, let me say it's great to be back at the Milk in Asia conference. And then compliance notice is I'm not a ratings analyst, so I'm an economist. It's a different part of the firm, but I can talk about how they think about these things. I wanted to try, and one of them's over there. I wanted to try to synthesize, I think the way to answer your question, Bill, is to try to synthesize what Joaquin started out with saying, which is a very sort of naive economist notion that the supply and the demand curves intersect and it gives you a price and a quantity, and the market clears, which obviously doesn't happen in the infrastructure space. And then what Gerald was just talking about, these various kinds of risks, and how do you kind of close that gap between where the supply and demand should meet. Gerald's obviously on the financing side, we're on the transparency side, right? So the difference, supposedly one of the differences between moving from a bank system to a capital market.
We like to think we're on the transparency side too. For what that's
I thought you were opaque, so we're enhanced transparency, but sort of the microscopic look, et cetera. But I wanted to pick up, since Gerald teed me up on some of the risks, I just wanted to go through, because some of the illiquid nature of these projects, and then sort of the duration. We've got construction risk, risk, legal risk, political risk, policy reversals, capital controls. You can come up with a whole bunch of things. And the idea, I think, is to try to kind of identify those risks, right? Because they're going to be sitting on a contingent, they're not going to be sitting on a balance sheet, but they're going to be sitting somewhere as a contingent liability. And what's going to happen with those, right? In some state of the world, those risks are going to possibly materialize. And do they sit with the issuer? Do they sit with the investor? Do they sit with the multilaterals? I think what we can probably say without too much controversy is the fact that we've had kind of relatively slow take-up of infrastructure in the region, and every time I look at the Asian Development Bank's unmet infrastructure number, it seems to go up every time they put out one of these 5-year reports. So something is not making kind of that market come together, which leads me to believe that some of these risks aren't being kind of properly absorbed. And again, in a very naive way, we're not putting the supply and the demand curves together. So I think AIIB is a good question, but I think, Bill, you raised the question earlier, if the AIIB is run on a similar basis to, say, the World Bank's MIGA or, say, parts of the Asian Development Bank, what are they going to do differently that's going to close this sort of persistent gap between, again, the supply and the demand? And I think that might be where the Chinese government comes in, because some of these risks aren't being addressed, structured, priced in a way that gets your guys together with the issuers who want these projects to come together. So sort of thinking about the Belt Road Initiative and the fact that it's Chinese sponsored. The AIIB, Jin Lichun, I've seen him speak several times. He's made it very clear the AIIB is not the financing arm of the Belt Road Initiative. If they see a proper project that meets the criteria of the bank, they will invest in it. But what happens to the rest of it? Do we get the financial markets involved? Do we do bonds? Do we bring in private equity? So I think something new about that gap. Again, the gap between the supply and demand, some of these risks that are hard to price, some of these gaps between social benefits and private benefits, they need to be closed. Or the risk is that we continue to kind of roll this model where the gap of unmet infrastructure needs continues to accelerate. Flip it around, the way it would close is some new actor, let's say the Chinese government, is in there probably trying to take out some of these risks.
Or another way, maybe mechanically to close it, is to write guarantees, right? Guarantees that give you some kind of insurance, not just against political risk, but also against other contingencies.
Refinancing risk.
Exactly.
Right.
But the trouble with guarantees is that often they're written in a way that they're not transferable. They're written in a way that they're hard to collect. In fact, quite often the current multinational banks write guarantees in a way where, almost by definition, they won't kick in until you do everything you can to collect, as opposed to ensuring the investor, Jerry's client, that, I'm protected.
Just to react to that, I think it's important that some of the guarantees are actually aimed at reducing risk rather than just reallocating them between project participants. And I think that's actually a good thing, because we talk a lot about who is able to bear which risk, but I think we're not talking enough about how to reduce risk, and by that I mean government risks. So many of the risks in infrastructure originate in the expected action or inaction of governments. So the question is, how can you reduce that risk? And that is really about allowing governments to make credible long-term commitments.
Right.
And that's where the MDBs come in. So if you look at the partial risk guarantees, for example, the nature of them is you guarantee a private investor that government performs on certain undertakings. But the MDB holds a counter guarantee against government, which means this guarantee will almost never be paid, because in fact we could immediately collect from the government. So it doesn't make sense for government to let this risk materialize. So I think that's actually, from an incentive perspective, a really good structure. I think there are a number of reasons why it hasn't spread as much, and I think at AIIB we're trying to, as we're developing our guarantee product, just talk to the market more to see what is it that has led to those not actually taking off. And I think there was too much sort of an MDB-ish perspective. Right. We think about this out of Washington, as opposed to we sit down with MTR, with investors, and ask, what do you actually need to make this happen? And what's the comparative advantage of an MDB to come into this deal?
Right, right. Let me toss that back to you, Jerry, in the following way. When you're addressing the loan committee, and here's a loan project, here's a loan that you say, this is great stuff, you guys should approve it. And so they start with the top line. What are the revenues you expect, right?
Yep.
It's good, right? And then what are the costs? And then on net, if it's really on the border, right, would that be where a guarantee would be able to kick it over? So guarantees are really relevant for that set of loans where the top line isn't quite enough to drive it, the costs are variable enough, but with a guarantee, I can lower the risk sufficiently that it kicks it over. So it's only for the class 2 or class 3 loans rather than to provide for truly good investment projects.
I don't know, because I don't think that the guarantors typically look at the world all that differently from a loan committee, because they have their own credit committee as well, and they think about themselves as being on the hook from day one for that. And so I don't necessarily think the guarantee is a fix for a marginal deal. I think the fix for a marginal deal is to either make it smaller, make it shorter, figure out some way to tailor the project that the debt will be able to be serviced, because really no institutional investor and no bank investor wants to be underwriting the guarantee on the way in. They want to believe that the deal is going to perform and pay out.
But that obviates the need for a guarantee. If a guarantee is to make a good loan better, right, then it's already a good loan. It's already approved, right? It doesn't sort of take a loan that's not approved and make it a loan that's approved.
Well, there's also the economic impact of a guarantee too, right? So the guarantee will almost by definition bring pricing down, because you're substituting the credit of the guarantor for the country risk or the various other risks that might be embedded in the deal but not readily apparent. And so having some wrap around that and just taking some things off the table so that people don't have to think about them is in some ways the function of the guarantee, so that people can actually focus on the economics of the underlying project and the likelihood that it pays out in full and on time. But the guarantees will continue largely because of country risk. And you look around the region, there are a lot of countries that are kind of triple B and double B or cuspy and or maybe have split ratings, where there is going to be some need for uplift and frankly pricing improvements for these projects to be economical.
Right. And as a shameless plug, I just want to say that part of the work at the Milken Center for Financial Markets, and Stacy is the head of right there, is that we are working on the nature of guarantees and what would work to help with a lot of these multilateral type lending opportunities. So again, shameless plug. Getting back to sort of the shadows of the financial crisis. I'm not just picking on you but these topics are so easy to pick on. I would not be doing you the right service if I didn't pick on him, right? Because banks are by definition evil.
Yeah.
Whoa.
Wow.
I thought we were
Welcome to the NFL. I can't wait for next year's invite. Like, well, I'm thinking about that.
But I think one of the things that's great about Generation 2 financial products is that there's more of a possibility of trading. And one of the things that really was the danger of having these risks sit on balance sheets was that they just weren't realized. You just couldn't mark them to market. There wasn't an active secondary market. And talk to me about the importance of secondary market trading and transferability.
It's interesting. When you talk to institutional investors, the first thing they ask is about what's the liquidity going to be. If it has a guarantee and an underlying exposure, can you strip the guarantee and trade the guarantee? Can you trade the underlying exposure? Because they're by nature profit-seeking and profit maximizing, and so they want to understand if the components of the exposure can be disaggregated, traded, and sold. And so, again, that I think is part of why it's incredibly important to have investors engaged in new issues. So you develop a book of investors who have exposure to the asset class, who understand the risks, and who stand ready to trade them, because that deepening and liquefication of the market is what makes this all work.
And in fact, that's exactly what I was hoping you would see, because I think the great thing about why it is that it's a misnomer to call banks sort of the evil, the dark side.
I think only you called them that.
Sorry, I'm reflecting my biases from.
They're great partners of ours.
From all the civic groups that I keep hearing echoes of, because they keep telling me when I went to Citi, you've joined the dark side.
I think they meant you were getting paid more.
But I think that the importance of these financial products is that now, if you can trade them, you can realize and mark to market those risks, and you can actually monitor how this project is doing day by day. And that really is critical to allow that global investor transparency and insight, which is exactly what Paul was talking about, right? Because your ratings are based upon having adequate transparency, but how on earth are you going to get transparency when it's a 20-year project, right? You don't, by definition, know what's going to happen in 5 years' time, in 7 years' time. And the key, I think, to minimizing a repeat of the kind of products that led to the previous crises is to have secondary markets.
Yeah, and I also think that the deals need to be well structured and well designed. And when you look at a project finance transaction, they're extraordinarily detailed, and the engineering work that gets done up front and the project specifications that get done up front leave virtually nothing to chance. And the ongoing monitoring and certification obligations provide investors, and from every part of the capital structure, from senior on down to equity, with a good degree of comfort that if something is going wrong, they're not going to find out about it 6 months later. They're going to find out about it almost immediately. And I think that's part of, I think everyone who is on the supply side of infrastructure financing opportunities well understands that investors expect that and won't participate without that.
And it's not just infrastructure, it's all other asset allocations. So getting back to my sort of setting up question, which is like, how do you have market signals in a financial system that's dominated by banks by doing what you guys do, right? By taking the bank products that they initiate and transforming them and giving them transparency, giving them legitimacy with different investment objectives, right? And that enables then market signals to come into a system that is predominantly bank-based. So so in some ways, I hope I redeem myself by saying these guys are the heroes, right? These guys are the heroes in trying to bring market forces into a financial system without markets. And I think the reason why that's important is because we hear a lot of talk in ASEAN and Asia in general about the Asian alternative, right? A lot of people are saying, we really lived through the 2008 crisis unscathed because we did not adopt a lot of the financial innovations that the West took on. And I think that's a mistake. It's a mistake to say that because these financial innovations are absolutely critical to allowing you to tap that global capital market. They're absolutely critical in being able to allocate resources efficiently because you're following market signals. If you just have a bank-based system where family ties and family private information is directing capital, that may work in a smaller environment, but certainly on a global scale, that just leads to massive distortions and massive moral hazard. But I think by having these market forces at work indirectly, by initiating in a bank-based system and transforming those assets into a market-based system, that allows the global market allocation to work even when there are no markets.
Bill, can I jump in? That's a really good point, because we're having the 20th anniversary of the Asian financial crisis, and we're speaking at different events, and including here at the Milken, you're looking back 20 years, and one of the identified causes, sort of ex post, of the Asian financial crisis was a very kind of bank-centric financial system, and we're asking 20 years on, has Asia moved away from that? And we tend to look at the size of the bond markets as a share of GDP or something like that. But we have that view kind of assumes a very monolithic, static version of what a bank is, right?
Exactly.
You have sort of liquid deposits and you make illiquid loans, and if you can structure the products in a way where the market signals get in and you can trade them and there's an information sort of flow between buyers and sellers, then the criticism that you're bank-centric it's not nearly as strong, right? There may be still benefits from having capital markets and other players in the financial sector, but we have to be a little bit careful with saying, oh, it's still a bank-dominated system if we've got this kind of banking one-on-one model with liquid and illiquids.
The reason why we can tag team like this is that Paul and I worked at the IMF, and when we were at the IMF, I think at the beginning of my career there, certainly, the favorite paper to write was, why are there no capital markets in Asia? And they're still writing that same paper, right? And the answer is still the same. Paul, I mean, check me if I'm wrong, but the rule of law, right? The certainty of property rights, the certainty that's associated with contract enforcement. Those are key ingredients that you need to have markets work. And in Asia, you just don't have that sufficient breadth and depth to be able to have the growth of markets.
That's changing now. That really is.
Yeah.
I mean, the institutional accounts that we see participating in the market are willing to take on those risks in a way that we've not seen them before, and not just because rates are at zero in developed markets, but because I think that 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 cycle or the bad old days or the system that you described, I think that's dissipating. And I think that there's more transparency than ever. There's more investor appetite for these types of exposure. And I think that these infrastructure needs are so great, and you're right, every time I open the paper, they do seem to go up. I also think that on the side of the issuers, there's a much greater appreciation of the need to operate in a certain way in order to access international capital repeatedly.
Right.
And so I think that the wind is blowing in the right direction on that. We're not entirely there yet, and that's why we still need wrap providers and multilateral development banks to get us to that end state. But when we're having this panel in 10 years, we'll be talking mostly about a market where banks play some, intermediation role in the front end, and institutional investors own the entire long end.
Exactly.
With or without wraps. So.
Right. I've monopolized a lot of discussion up here. Let me toss it open to the audience in terms of, do you guys have any questions for this great panel? Please.
Hi, Faisal Syed, Trump Advisors. It's implicit with the panel. I had other questions, but let's start with this one. It's implicit in the panel, and you didn't use one phrase which is popular during such discussions: public-private partnerships. Do they work? I turn that over to you.
Joaquin, you want to start with that one?
Well, it's sort of, I think you discourage the sloganism or the, PPPs as a term describes so many different arrangements that it doesn't, as a term, doesn't help the debate a lot forward. I think what I said initially was almost all infrastructure has a public dimension because it is physical, because it is so, it has often public good elements, some natural monopoly elements. So you will never get around the public P. But in a sense, the entire discussion here has been around how to make the second P work. I mean, what are the conditions that you get the private sector added to the first P? And I think we've discussed some really interesting models here. So, for example, this idea of the takeout facility. As soon as you bring some sort of enhancement to that, you actually have a public role there. Let's say if an MDB comes in, that's a particular way of a public role. But even before that, at the level of each project, you have a public policy role, you have a public regulatory role. So that's why I think it's good to drill down beyond just the headline of PPP.
Right.
I think in the 90s, there was sort of this, in Washington in the 90s, there was sort of this little naive thinking that it was now, infrastructure had now moved to the private space. And I think that sort of forgot the fundamental importance of public policy as the context for any infrastructure, much more than in manufacturing, much more than in many other sectors that don't have these public good dimensions. So yes, and I think we have made progress. The discussion here shows we're actually talking all about PPP.
In fact, this is all about PPP, and the second P part of it is the hardest part to bring in. That is, how do you bring in private money? And by structuring it properly, right, by giving it some transparency, and by operating it in a way that guarantees that the revenue sources are going to be strong.
I think it's the public partners problem, but I'll continue.
But William, we at MTR, we participated in a number of PPPs, both in the mainland of China as well as in Australia. For us, and we participate both as a proponent, as a contractor, as well as an investor, an equity investor. And we, as equity investors, there would be private equity in some of those structures as well. For us, one of the key ingredients would be the extent of risk transfer from the first P, public, to the second P, private. A number of governments may think, well, here is a great PPP, the middle P, private, can take all the risk. That's where the PPP concept may not fly. So where there's adequate risk transfer, or where there's risk transfer where both Ps can bear their proportion of risk, and who's best placed to bear what
and
risk.
The appropriate type of risk.
And
right?
the appropriate type of risk. That's where we find the models work. So we're involved in a PPP building Melbourne Metro, Sydney Metro Northwest. We're involved in PPPs in the mainland of China, where the extent of transfer of risk have allowed for that private investment, both on the debt side and the equity side.
Anything else? Stacey?
When we think about risk allocation, typically we tend to describe it in terms, in vertical terms, in terms of the capital stack. And I'm wondering if you all could discuss, and in particular maybe Citi and the AIIB, a way to
Sure.
again.
Would you like me to start, or do you want to?
Good.
Sure. So look, I think the basic issue is who's going to take that risk? Is it going to be the project and the equity, or is it going to be the debt, right? Because it really is a debt refinancing risk that we're talking about here. And if you conclude that the project and the equity is going to take the risk, then you either have a hard maturity that needs to get refinanced or not, or you can put in place a structure that goes into some sort of accelerated amortization where there's no cash flow to equity and the deal pays off if it's not refinanced at some expected date, where the deal pays off quickly. And then that crushes the equity returns, the debt gets paid out. It's usually not pleasant or pretty to watch, but the debt holders go home happy, the equity holders, who are typically the public part of the PPP, it usually doesn't work out to the way it was modeled. That's if you leave all the risk there. I think the more interesting structures are the ones where you do have that sort of maturity transformation function or insurance or optionality, where you do have a multilateral development bank who might be willing to own that refinancing risk at year 5 or year 7 or year 10, or wherever the appetite from institutional investors drops off. And so those and that can come in any variety of forms. It could come in the form of a guarantee if it's not refinanced. It could come in the form of a put option to a multilateral development bank or some other support provider. Or it could just come into some straight refinancing agreement where there's an agreement that if the deal is not refinanced into the markets, then AIIB or someone else agrees to fund the loan. And then the initial set of debt holders get taken out. And so there's a lot. I mean, the good news is a lot of these technologies have existed in other contexts, been used in other contexts very successfully, and now they're just being applied to infrastructure in scale for the first time. So I think there's a good number of things in the toolkit to work with.
I mean, just to add a little bit, I mean, you have the greenfield phase and the brownfield phase, and you have quite different risks. I think if one is able to develop a market for the brownfield stage, the lower risk, the operating assets, if there's a sense that there is a liquid market for assets of certain quality with certain characteristics, that should influence the actions of the greenfield investors up front, because they know once this is an operating asset that has a predictable cash flow, that meets certain criteria, they can sell it at well-known prices. I think that's why I think starting from the end, sort of creating this market of the brownfield assets is a really promising approach, because I think that will then trickle upstream and make it easier to invest upstream, because you know that if your project meets certain criteria and gets over the greenfield construction risk hump, etc., you can actually sell it.
So are you doing that?
We will underwrite deal. This is not a public offer, but as a matter of like stuff we do, we will underwrite deals that we think are either very good construction risk with a known operator and a known off-taker where we like the credit. And for us, the worst thing that happens is the refinancing doesn't happen and we wind up stuck with a credit that we like with a known operator. It just happens to be for a longer time. But certainly if we feel like there's a capital markets takeout to something and there is a construction risk that is 2 or 3 years down the road, we can take that risk as a bank, certainly. Like that's not a problem. And I don't think that that's a major gap in the market. The issue is that entails some risk that not everyone is comfortable taking, and I think there's a relatively small number of very seasoned project finance banks like Citi where we actually feel like, one, we're able to assess the likelihood that the sponsor completes the project and it becomes operational and cash flow starts coming through, and two, where we would go to refinance the exposure. And if you don't have both of those, it's very, very hard to underwrite, and so it's very hard for banks to go into their credit committee and say, don't worry, Citi knows what to do with this, they'll take care of it. That's not a great answer for the rest of the world, even if that might be our own answer.
I think we're just about running to the end. Is there one more question out there?
Let me play devil's advocate.
Go.
Go.
You're on the debt side.
Yes.
Where I see the gap is my first question. Is there a shortfall of equity, debt, or hybrid securities? I would say there's a shortfall of equity. And because that's, if you remember why Asia got into its crisis, there was a lot of bank financing, but not sufficient equity in the capital structures of many companies. And so if there is something innovative that can be done about the equity piece to encourage that, like of some form of takeout, some place to go, then you'll see a lot of money flowing in from the West out here.
So I agree. And when you asked your question about public-private partnership, what we didn't say is, I think when people talk about public-private partnership, they think of partnership as in partners in the equity, right? I think we talk about public-private partnership thinking about the capital structure as an entirety consisting of some parts public and some part private. I think what you're talking about is you've got private equity and public equity, not listed public equity, but public equity in the sense of a company's or a country's equity sitting at the bottom of the capital structure. I agree with you. I think there is a big hole to fill there. But again, I think some of this has to get worked through over time. You need a set of investors who understand the universe of investors that really understand project finance is not enormous. And so asking someone to take equity risk, which is the most extreme kind, doesn't happen overnight. There are a number that are very knowledgeable and extremely capable of taking it, but not a ton, and you're right.
I'm going to have to cut it short because I'm told that we've run out of time and we need to clear the room soon. But,
all right.
But thank you all for coming.
Thanks,
Panel,
Bill.
thank you so much.
All right.
I really appreciate the time.
Bill,
Gentlemen,
thank you.
Thank you.
Thank you so much.